Okay, I think we'll start. Good afternoon, everyone. I'm delighted to welcome you to our webinar on doing business in the United States. This is always a topical subject and one where there is a vast array of potential pitfalls, but we have assembled a first-class panel to help navigate you through all of those problems and help you come up with solutions. This afternoon is a collaboration between Moore Kingston Smith, Citron Cooperman and SelectUSA. Moore Kingston Smith are a leading firm of chartered accountants based around London and the southeast of England. Citron Cooperman are one of our partner firms. They are a top 20 firm in the United States who I always think of as being based in New York, but that frankly doesn't do them justice anymore because I know they have offices all down the east coast of the States and also have a burgeoning practice in Los Angeles. Both of us are members of More Global, which is a network of accountancy firms across the world where we can offer advice in 110 countries. SelectUSA is a federal program established to drive economic growth and create jobs in the United States, so they can also hopefully give us a unique perspective. I'll introduce our speakers individually as I go. My name is Graham Tyler. I'm chairman of Moore Kingston Smith. And happily for me, my role today is very simple. All I have to do is vaguely keep our speakers on time and in line, and also encourage all of you to post questions in the chat, please, as we go. I will try as best I can to see if the speakers can answer them during their sessions or at the end of their sessions, or hopefully we are geared up to have plenty of time for a question and answer session at the end. So with that said, without further ado, we will start for my purposes with one of my partners. Mike Hayes is a leading international tax partner in our practice. He has a particular expertise in the UK-US market and is part of our North America group. So Mike, over to you.
Thank you, Graham. Just bear with me whilst I share my screen, which I hope is going to work properly. I did practice beforehand. Just let me display settings. I think that's not quite the right setting. Well, I hope you can all see that. So
yeah, you're good to go.
Good. My name is Mike Hayes, tax partner at Moore Kingston Smith, as Graham tells me. I usually do this as quite a lengthy PowerPoint presentation, but I've effectively reduced it to one slide because I think it probably works better. So this is relatively PowerPoint free. So I'm going to just run through those bullet points that are on that first slide and just talk you through some of the major issues we need to sort of discuss if you're thinking about setting up in the States. Now, the first thing, if you're doing business in the USA or with the USA, is to decide, are you liable for business taxes over there? And this really depends upon whether you actually establish a business presence, or what is often referred to by the technocrats like me as do you have a permanent establishment over there? Now, generally speaking, if you start to engage staff in the USA, or if you take on business premises, you're almost certainly going to have a permanent establishment. And if you're doing that as part of your UK business, you're effectively got a branch in the USA, and you will need to pay corporation tax in the USA or corporate income tax on the appropriate level of profits. Not all, that doesn't always mean you've got a business presence. For example, if you just take on a warehouse, which is simply used for the delivery of goods, that is not a permanent establishment. Also, if you engage an independent sales agent and they're genuinely independent, in other words, not an employee, that is not that does not give you a business presence over in the States. So it's something we need to look at and establish whether or not you've got a business presence. One of the things I should warn you about is that frequent visits to the US can give rise to creating a permanent establishment. And the one case I recall is where we had a marketing services company in the UK who were doing business for a client over here, and they were then engaged by the parent company in the US, and they would regularly send somebody from the UK to the US for a week every month, and they would work at the client's premises. And the advice we had was that, knowing that you've got accommodation available for working out of at the client's premises in the USA was sufficient to give rise to a permanent establishment, and obviously then an exposure to US tax. So just be aware of working on clients' premises, and that's something you would need to take local advice on. If you have a business presence in the USA, should you actually form a US entity and trade with the entity rather than as a branch? And my general view is, as soon as you start to sort of dip your toe into US corporate taxes, I think you should set up a local entity. Firstly, I think it clarifies the division between the UK and the US much more easily. It also gives you some protection from US litigation, and I'm sure we've all heard about some horror stories about US litigation, but also it makes it much easier to do things like take on staff and perhaps lease premises, etc. Generally, businesses in the US do prefer to deal with a US corporate entity when they're contracting with it, even if it's owned by a UK business. So generally, I would actually say, given that you're going to have to file a corporation tax return anyway in the States, actually having an entity there does not add too much to your costs. Bear in mind, of course, that an audit of your US companies is probably not going to be required for US purposes. So if you decide to have a US entity, which one should you have? And there are a plethora of entities in the USA, more so than in the UK, partly because there are more different types of entities, but partly because each state plus Washington, DC has its own corporate law. So it's not as simple as it is in the UK. But when you look at the entities you should think about in the USA, you're generally coming down to looking at two different ones. And the first one is called a C corporation, which you can recognize because it's got the letters INC, Inc. after its name. And that is the one that's most similar, in my view, to an ordinary UK limited company. It is a corporate entity, it has stock or shares, it has directors, etc. But one of the more popular entities in the US, certainly for domestic use, and a relatively new one, is the LLC. Now, LLCs are very popular in the States, but they can give rise to problems from a UK tax point of view. And generally, we would advise against using LLCs. And that's for two reasons. One is, if you're an individual investor in an LLC, you may end up with double taxation for technical reasons, which I won't go into in the space of time I've got. The other reason is that if you're a corporate investor, owning an LLC can be problematic. And the reason for this is that LLCs generally do not have share capital. They look a bit more like a partnership, although they're not a partnership. And for a variety of UK tax reliefs, in particular the Enterprise Investment Scheme, and also for EMI options, one of the conditions is that if you control a corporate entity, which an LLC is, you've got to own more than half the shares. So if you control an entity which doesn't have any shares, you don't actually, that's not a qualifying subsidiary, and it will disqualify your company for EIS, EMI, and one or two other things. So a great deal of care over the choice of entity is really quite important. Next question is, who should own it? Well, certainly you could own it separately from your existing UK company, but I would imagine that you probably want to actually have it within a group, so owned by the UK. All I would say as far as that's concerned is that if you're a standalone UK company at the moment, I think it's good practice to consider putting a non-trading holding company in place so that it owns the UK operating company and the US operating company as separate subsidiaries. That does provide an element of risk mitigation, but that's something that a buyer would expect to see if they were looking at your company. Who should be directors of the US company? Well, it really helps if you can find a US director, which I know for a US startup is not always easy, because you perhaps don't know enough people over there, or certainly you don't know people well enough to trust them to be directors. But certainly when it comes to opening bank accounts and things like that, it really helps if you've got a US director with a US Social Security number. What I would also say is one of the things you have to avoid is making the US entity tax resident in the UK as well. And an overseas company can be tax resident in the UK if it's managed and controlled from the UK. And management and control is normally determined at board of directors level. So if the UK directors become directors of the US entity, excuse me, and they hold board meetings in the UK, it's likely you're going to make the company UK resident as well as it being US resident, which just complicates the tax. So having a US director is advisable if you can do it, and certainly holding the board meetings outside the UK for that entity is something you should consider. So there's a governance issue there. I'm often asked which state you should form the entity. Generally, we opt for Delaware, not for tax reasons, but it has probably the better understood corporate law. So we would normally recommend registering it in Delaware, but that's not the only choice. I mean, you've got plenty of others. So Delaware is probably the place we would recommend. In which state will it be taxed? Well, generally, you're not going to be taxed where the business is incorporated unless you do business there. So you are going to be taxed in the state or the states in which you have a business presence. And that becomes quite an issue for a number of reasons. One of the things I would say is that if you're choosing to actually open up in the States, unless you have a particular need to be in a particular location, I would look around the States with a degree of flexibility and just see what's on offer. Many of our clients think you have to be on the West Coast or in New York, but I have to say that they've got the worst state income tax rates out of all the US states and can be expensive places to do business. So unless you have a commercial need to be in those particular locations, you could consider other locations which have lower state tax rates, even zero tax rates. I often talk to clients about establishing their businesses in Wyoming, and because they've got no state income taxes. And to be fair, nobody's taken me up on that offer yet. So I'm not sure what that says about Wyoming, but certainly think more widely than the West Coast and the East Coast is a good bet. And finally, I was just say one more thing, and that is if you're sending staff over there, maybe you're going to go over there for a period of time, for a number of years, there are clearly going to be visa issues which you need to address. Now, one of the things you might be tempted to apply for is excuse me, is a green card. Now, a green card makes it much easier to get in and out of the USA and for return trips to the UK, et cetera, and that is certainly the case. One of the problems with owning a green card is that as a green card holder, you are liable to US taxes on the same basis as if you're a US citizen. So if you're a green card holder and you've done your 3-year, 4-year stint in the States, you come back to work and live in the UK, if you retain your green card, you will still be liable to file US tax returns and will have to pay some US taxes. If you decide to give up your green card, subject to certain conditions, one of which is that you've got more than $2 million worth of worldwide assets, you are treated as selling all those assets at market value, and you will pay US taxes on the capital gains arising. So green cards come with a health warning. Excuse me. I'm not suggesting don't actually have a green card, but I do think you need to do it with your eyes wide open. And I think that's probably taken up my 10 minutes or so. So I will just look at the next couple of slides because they are something I'm not going to go through. On this slide, which will come out to you with the pack after this event, I've just indicated who typically does the elements of work when advising on setting up in the States. It'll be us, Citrin Cooperman, or a US attorney. That's not in tablets of stone. And then also I've put a number of checklists on the slides, which I'm not going to go through, but they ask the sorts of questions that we would need to be talking to you about, and Citrin Cooperman would need to be talking to you about when you're thinking about setting up in the States. So you can actually take these and use these if you're thinking about setting up in the States. There's one on structure, there's one on HR, and there's one on operational matters. And that will give you some background into what we need to do and what we need to talk about. So Graham, that's me done, I think. So I will close my presentation.
Thank you. That's great. There are no direct questions immediately in the chat for Mike, so we will go on. That's obviously a quick run through of things from just a straight UK perspective. And I'm delighted that we have not one, but two experts from Citrin Cooperman with us to look at things from a straight US perspective. So once you're there, what are the issues when you get there? So I'm going to introduce you to Carly Clark. Carly is a member of Citrin's International Tax Group and who specializes in US tax compliance and planning on international tax matters. And also available to us when we get to questions is Jennifer Sklar. Jennifer is a principal in Citrin's International Tax Services Group. She advises on a range of cross-border tax planning and reporting obligations and analyzes the impact of US tax treaties on foreign jurisdictions. So she probably hasn't got much time for anything else, and therefore we're incredibly grateful that she is here with us. So Carly, over to you.
All right, thanks, Graham. Share my screen. All right, so can everyone see that?
Yeah, you're good.
Okay, great. All right, thanks. Yeah, so today I'm Carly Clark. I'm an international tax supervisor at Citrin Cooperman, and today I'm going to talk to you about what to expect when doing business in the US from a US tax perspective. So what can you expect when you're doing business in the US? So what are some common reactions from our clients when doing business in the US? First off, our clients are surprised by the number of taxing jurisdictions in the US. As there's the federal tax government, and then as well, there are 50 different states and their localities that can tax your business, depending on where you do business. Each of these 50 states have different tax laws and regulations, and they also have different tax rates. Also, the US is seen to have a very complex form-based tax system with very significant penalties for failure to submit correct forms or submit those forms late. This is especially true for international tax forms. Even informational foreign forms can have a $10,000 penalty for not submitting them. So it's really important that our international tax clients understand what forms they need to submit and that they submit them completely and also timely. Another common client reaction is that they're surprised to find out that their foreign entity is taxed differently in the US than it is in its home state. This is really common with UK LLPs or UK LPs in particular. So it's important if you have these type of entities and you're looking to possibly set up in the US to talk with the US tax advisor and to understand if that entity will be taxed as a pass-through in the US or if it will default as a corporation and be taxed as a corporation. Another common reaction is that there's high levels of withholding taxes on interest, dividend, and royalty income when paid to a foreign person, unless an applicable tax treaty applies. So it's really important if you're going to have these types of incomes paid to a foreign person that you understand if the tax treaty applies and you also have the proper forms filed to claim any reduced withholding rates on those incomes. If not, the withholding agent's required to withhold at 30% on those type of incomes. The US does have a treaty with the UK, and there are possibilities for reduced rates. So this is really important for UK businesses. Lastly, it's just a common reaction that clients see the need for their professional advisors to really work as a team, meaning their US tax advisors speak frequently with their UK tax advisors and everybody's in the know. Just like Mike Hayes mentioned, if there could be entities in the US, like a US LLC, that's not efficient for a UK business to have because it's taxed differently in the UK. So it's really important that your professionals all work as a team and really communicate frequently. Another topic I wanted to talk about was what business taxes are businesses exposed to in the US. First off, there's income taxes. Again, this is at the federal, state, and local level. And depending on how the US views your business, you're either going to be taxed at the entity level, or the income is going to flow through to the members and be taxed at their personal tax level, so on their personal tax returns. Also, businesses could have payroll taxes. If you have employees, you may have to pay Social Security tax at a rate of 6.2% of an employee's gross salary. The same rate is also going to be paid by your employee. You could have Medicare taxes at a rate of 1.45% of an employee's gross salary. And again, the employee will pay the same amount in. And then lastly, for payroll taxes, you also could have federal and state unemployment taxes you have to pay. So yeah, so in the US, you can definitely have a US payroll company. We can refer you to someone. And then also just to note, in the US, your employees will receive what's called a Form W-2. This is going to show their annual income and their taxes paid in, and then their withholdings. This is the most similar form to what the UK has called as the P60. The difference is that the W-2 is going to be on the calendar year, because personal taxes are paid on a calendar year in the US, rather than how the P60 is on the April to April basis. And then lastly, I just want to discuss sales and use tax for businesses. Businesses could have to pay sales tax if they're selling a product. They have to remit this on behalf of the state. And then there's also use tax. If you're a consumer, you might have to pay use tax on purchases that you make. I wanted to make a note that the US does not have a VAT or GST taxing system. The closest thing would be the sales and use tax. So what are the corporate income tax rates in the US? Currently, the federal corporate rate is a flat tax of 21%. And that's for now. The Biden administration is discussing possible increases to 28%. So I just wanted to note that. There's also the state and local taxes that have been discussed numerous times. I didn't point out a few states below that are very common. As Mike explained earlier, the New York and California taxes are high. These are the popular states to do businesses in, though. But just to illustrate, if a business, for example, if you have your media business doing most of your business in New York City, you could have income subject to the federal tax at a rate of 21%. Then also that income would be subject to tax by New York at 6.5%. And then on top of that, you could have New York City tax at 8.85%. Then two states without corporate income taxes, Wyoming and South Dakota. So what are some deductions and credits that could be available to your media business? Some popular deductions and common deductions would be that in the US, there's currently where you can accelerate expensing of capital expenditures, meaning you don't have to take a capital allowance or depreciate the asset over time. Instead, you can take the full cost of that asset on your return in the current year when you purchase it. There's also net operating loss carry forwards in the US, meaning that if your business has a net loss in the current tax year, you have the possibility to carry forward that loss against future incomes. There's also meals deductions if you have employee meals or if you have business meals. There's some particulars to that, but there can be deductions possible for that. And then also, of course, expenses for ordinary course of business the US allows. And then lastly, I just wanted to point out there are federal and state tax credits and incentives depending on your business size and what type of industry you're in. So for a media business, it would be important to talk to a state and local tax expert that can explain to you what sort of tax incentives there are for your media business, like TV and film, in what states. And then let's see. Oh, and then I just wanted to kind of touch on personal income taxation in the US. There's an importance of residency and understanding if you're non-resident or resident in the US. And this is because non-residents are taxed only on their US sourced income, while residents of the US are taxed on their worldwide income. This is similar to US citizens. Also, residents of the US have worldwide asset reporting, meaning if you have foreign bank accounts or if you have stock ownership in foreign corporations, or if you have brokerage accounts, you could have reporting on an F-bar or a Form 8938. These are informational filings, but again, these are the type of filings that are informational, that if you don't file them completely and timely, you could have a $10,000 offense. So it's very important to understand your filing requirements when you're a resident. And also as a US tax resident, if you have ownership in foreign entities, it's really important to understand if you have any annual filings for those. For example, a lot of our clients have ownership in UK limited companies, and if they're majority owners, there can be extensive annual reporting for those entities. So it's really important to understand if you have filings for that. Lastly, there's availability of foreign tax credits. So if you're reporting your worldwide income on your US return and you're paying payments to HMRC, for example, you're allowed to take foreign tax credit against your foreign income so you don't get double taxed. And then I also wanted to just talk about the two tests to understand if you're a resident alien of the US and are taxed on your worldwide income. So there are two different tests. There's the green card test and the substantial presence test. The green card test is simply if you have a green card, you're considered resident alien of the US, you have to report your worldwide income. And then the second test is a substantial presence test. This is a test done on the number of days in the US that you're physically present. Just a breakdown of that test, it looks at if you're at least 31 days present during the current tax year, and then it does a look back where it says, okay, were you at least present 183 days during the 3-year period that includes the current year and the 2 years immediately before that. And the test goes that it counts all the days in the current tax year, plus it takes a third of the days of the first year before the current tax year. And then finally, it takes a sixth of the days in the second year before the current tax year. So that calculation is done. And if you meet 183 days, you could be considered resident alien because you passed the substantial presence test. And then lastly, I just wanted to discuss that even if you do pass the substantial presence test and are therefore considered resident alien, have to do worldwide asset reporting, worldwide income reporting, there are certain situations where you could still be treated as non-resident alien if you meet, for example, the closer connection exception, or if there's treaty residency tiebreaker rules that could be applied to you. So it's important to understand if you could still be considered non-resident alien when looking at if you pass the substantial presence test. And then my last slide, I just want to talk about the personal income tax rates in the US. So the US has a progressive tax system, and currently the marginal tax rates range from 10% to 37%. And I listed out kind of the lowest bracket and the highest bracket just to give you an idea of the income levels for those tax rates. So basically about the first $10,000 for a single or married filing separate taxpayer will be taxed at 10%. And as your income goes up, those rates will go up. The highest tax bracket doesn't kick in until for a single or married filing separate taxpayer until your income's greater than $523,600. And then for married filing joint, you'll see on there, I listed out the amount and it's $628,300. And then this brings up a good point for UK taxpayers. In the US, you can file it jointly. So there is that possibility if you have a spouse that comes over with you. And then the state and local income taxes can apply to you on the personal level. For example, if you're a resident of a state, you typically have to report all of your income in that state. And then also if you have incomes from certain other states, you may have other tax filings as well. I listed out the common states below. New York City, California, North Carolina has a lower taxing rate, you'll see. And then there's also a few states with that doesn't have personal income tax. And two of the common states that don't have personal income tax that we see a lot of clients reside in is Florida and Texas. So that is what I have to talk about for my presentation. I did want to just show the different offices we have throughout the world, actually. So we have offices on the West Coast, the East Coast, and we also have offices abroad as well.
Thanks, Carly. That's great. Actually, while you're there, a question's come into the chat, which maybe either you or Jen or together you want to pick up, which is the state local corporation tax rate charged based on where the customer is located or where your company is registered?
Yeah, Jen, do you want to take that one?
Hey, Jen, you're on mute. We need to unmute you, please. Perfect.
Well, that wouldn't make sense for me to answer if no one can hear my response.
Okay.
So it really depends on the state. Like Carly mentioned earlier, when it comes to the states, there's different rules, just like, you know, in the EU and just like in the UK, you guys have that, and it could be different, you know, it could be different country by country. For the states, it's the exact same thing when it comes to that. A lot of the states are moving to a market-based approach, where they're essentially looking, where are you generating all of your income, where are your customers located? So it used to be more of a physical presence test for many years. Where are you located? Where are your employees? And you know, where are your fixed assets, that sort of thing. A lot of states did allocations and apportionments between payroll and sales. So there's been a lot of movement over the years, but now I believe that a lot of the states are now focusing more on, you know, where are you generating all of your income?
Okay, thank you. One more while I've got you both, which is income from a US CARES Act loan that has subsequently been forgiven taxable?
Oh, the PPP loans we're talking about.
The PPP loans we're talking about.
I wish I had a PPP expert from Citron Cooperman on for that. I believe that there are a number of rules and there are certain requirements that you have to meet in order for it to be forgiven.
What I would suggest, Andrew, who's asked the question, maybe if you want to send us your details, we'll get Jen or Carly to give you an answer after the session.
Absolutely.
Okay. Thank you very much. I'm sure more questions will come in, and that map obviously explains much better where Citron Cooperman are than my very basic explanation earlier, but I think I was broadly right. So thank you for that. And we're now going to introduce you to Gus Franklin Butte from SelectUSA. Gus is a senior regional investment advisor in the UK, based in the US Embassy. Unfortunately, Gus is having a few Zoom challenges, so I think he's able to join us verbally, but maybe not pictorially. But he provides strategic market entry advice to companies of all sizes and sectors who wish to enter the US. So, Gus, please, over to you.
Thanks, Graham. Thanks, Mike. Yeah, I apologize. I'm blaming on the U.S. government. So Zoom is one of those devices that we are not permitted to have on our one of those software we don't have on our devices. So we use it in browser, but of course you never know what happens when you log into a computer that's where you would normally work from. So apologies for everybody. But no, thanks very much. You know, for being here today with Moore Kingston Smith and with Citron Cooperman. So my role is, you know, as Graham mentioned, I manage a SelectUSA program, which really is about facilitating inward investment in the US, and we really are there to kind of help work with companies who have active plans to go into the US, and really to help them navigate the federal and the state business environment. We're not the experts, you know, like Carly, like Mike, for example, but we are there more as a sounding board and as a federal resource. And obviously we work closely with you know, private industry partners like Kingston Smith, like Moore Kingston Smith, as well as with UK governments, DIT, as well as maybe London and Partners and other industry agencies. What I really just wanted to do is to give you a little bit about what SelectUSA is and kind of how we work. So it's not as detailed and as interesting as tax planning and compliance. But you know, one of the things I wanted to say firstly was that from what we see here, there are broadly maybe 3 catalysts that sort of drive a company's decision to set up the shop for the first time in the US. There's that kind of pull situation, and the pull situation could be, you know, moving from selling into the market, that kind of trade model, to having boots, eyes, and ears on the ground, and because you're required to kind of service existing clients or try and win new business. The other aspect, I think, is maybe a push function. So this is sometimes when you get a new deal, maybe new contract, or new investors, and you effectively have to be on the ground to respond and to manage clients. It's kind of a growth opportunity play, if you like. And then I think the other thing is almost kind of reactionary, right? So the kind of market shocks, that compels companies to pivot. Maybe it's Brexit or COVID, economic crisis. So they're broad categories, if you like. I'm going to go on to the next slide, because each of those situations, to some extent, helps to determine how we kind of work with companies. So we broadly kind of work on three kind of buckets of services. What we call market research, which is about really providing what we call actionable information. So these are the information that would help you to determine where in the US, how do you structure, and then of course we work, this is where our relationship with our partners come from, where we can kind of, not make recommendations, but then we can hand over to companies that we know can provide that information, be it legal, be it tax, sometimes it's immigration, sometimes maybe it's about requiring FD approval, depending on what sector you're in. So our role is really about trying to make sure that you are well informed, and that actionable information sometimes is in the form of a customized location report, and I'll touch on that a little bit later on. The second bucket, if you like, is kind of our platform for events and services, and we work effectively with every state, city economic development agencies, and they often, I would say, are the they have the Rolodex of contacts within their locale, the tax experts. They're also obviously the guardians of state credits and incentives. And again, I'll maybe flag a little bit about that afterwards. And then the other area, I think, is what we call the Ombudsman Service. This is really about helping to navigate the federal system. Obviously, the US is a huge market. We know it's incredibly fragmented in many ways. And sometimes it can be quite daunting, even for those companies that kind of know and have been doing business with, in the US. It can still be daunting when you kind of come to maybe, set up a new strategy or change the way you're going. And then on the next slide, really, it's just really quickly just to say, look, we are, as a resource, a kind of a key partner. Certainly at the embassy here, not just in terms of SelectUSA program, but broadly the US commercial service. Most of my colleagues are working with US companies coming in this direction. And then we obviously have the wider reach of across the embassy itself. And there could be something up to 50 odd different federal agencies sitting within the embassy here. So we have a fairly good reach. SelectUSA, I said, is a program within the Department of Commerce, and the Department of Commerce is incredibly extensive, again, both in terms of resource, reach, and touch. And then the other key partners that I work, as I said, on almost on a daily basis is with state and city officials. So we're a key partner. So a little bit about the sort of, I would say, the free tools on the next slide that we're gonna touch on. Basically, I'm not going to go through everything. And if anybody's interested in this stuff, I can direct you to where this stuff is available on the website. I'm just going to touch on really on one thing, which is kind of what we call our cluster mapping tool. And the cluster mapping tool is effectively developed with Harvard Business School in partnership with the US Economic and Development Administration. And really the tool is about helping companies to...
I'm speaking right now. I'm in a meeting for a little bit longer. I'm so sorry. It's okay.
Well, can we go on mute, please? So that
sorry.
the
Yes.
Gus can finish. Thank you.
I'm so sorry, Gus. I apologize.
No worries, Gus.
No, I thought I was going to get interested in that. It's fine.
I've got painters here. I apologize.
Nah, it's fine. No worries. I completely understand. That's our life these days. So really, yeah, the cluster mapping tool. It's really about we utilize tons and tons of open data, and it's about really helping companies to really maybe figure out where industry clusters that may be relevant to them. Maybe sometimes it's innovation hubs. It's about understanding what the US looks like from a state level, sometimes at an economic development region, even going as far down as a county level. And you can interrogate this kind of data. I'm going to show you a little bit on the next slide. You can interrogate the data by regions, or by, in this case, this is just a snapshot of what we call the actual clusters. And you have effectively, you can't probably see it too clearly, but there are 51 what we call traded clusters. And these are kind of, whether it's, in this case, whether it's apparel or it's IT systems. And there are subclusters that sit beneath each of these. So you can interrogate the data by cluster format. There are 51 traded clusters, and these are basically businesses that are doing that have a reach outside of their locale. So maybe they're trading across the US or even internationally. And there are about 16 local clusters. So these could be considered like the mom and pop stores, one outlet operating in their particular neighborhood. Let's move on. I'm going to show you just really quickly on the next slide, a really simple snapshot. It's about creating heat maps, and you can interrogate the data. Maybe it's about employment levels. Maybe it's about the type of patents that's been filed. So there are many ways to interrogate this data, and I said it's publicly available. This is a quick snapshot, for example, of financial services firms based on levels of employment. You can look at it at the state level. Sometimes when I'm kind of interrogating the data, sometimes I like to go a little bit deeper, maybe looking at economic regions or even counties. So obviously the brighter the color is the higher the concentration, if you like, of of that particular cluster. And if you think financial services, we know New York, but I don't think many people would kind of consider maybe Phoenix, Arizona, or even Miami as a potential location to consider. And this could be not just from a location point of view, but it might be from a client planning point of view. Where are your clients located across the US? On the next slide, I'm nearly finished, don't worry. On the next slide, I'm going to touch basically on state incentives. So we know that Carly mentioned, and I think that the ability to really work with local tax advisors, but we publish on our website a database of all the publicly available or published state incentives. Again, that can be interrogated. We always say it's never important. It's never it's never good to make an investment decision or location decision purely based on incentives, but sometimes it's a good starting point. And the other thing we also say, of course, is that these things are negotiable. So the information that's publicly available may just sometimes be a starting point for to help in your shortlisting your potential location. I'm not going to go on. I'm going to leave it there. But this is just basically to say this is some of the work that we do behind the scenes to be able to help companies to make informed decisions about their US strategy.
Actually, Gus, while you're on incentives, right? One of the questions we've had, and just relative to the slide you were just talking about, is are some states more receptive, re-encouraging UK marketing agencies to land there? Do they offer specific inward investment support aimed at these types of companies? So when you talk about their state incentives, is there an easy place for our clients to find out what incentives or grants are available to them in each state?
Yeah, so I mean the link that I can share, I think it's on that the previous slide, the penultimate slide. It's basically online, publicly available, and I can more than happily share that. This is I don't know if you can click back to it, but if people wanted to, I can put the link in the chat. But the reality is that the information that states put out, for them, it's just the starting point. And I think when it comes down to maybe having your top 4 or 5 potential locations, often state incentives and support could be across county lines. If you're in one county as opposed to another, the support that you may get from a state level could vary. Often it's around payroll. It's about jobs being created. They are often negotiated over a period of time. But absolutely, I mean, I think it's. I would say if there was 5 things on the list to determine where you go, maybe the state incentive may be and credits may be number 4. But yeah, absolutely, I'm more than happy to provide the link to anybody who's interested in terms of to get them going.
Thank you. I didn't mean to cut across you. You can finish off, Gus,
That's
please.
Fine. No, I'm good.
Okay. Well, in which case, thank you. Thank you to all our speakers. Maybe I could ask, I know Gus can't get his screen on, but maybe I could ask Mike, Jen and Carly to put their screens back on, and we can take a few questions that are kind of come in. Interestingly, only because Mike and Carly both mentioned Wyoming, do you guys do much business in Wyoming? Is there a reason? I mean, Wyoming has always been put forward to me as a kind of, this is the future because there's no state tax. But like Mike, I've never seen much done there. Is there a lot of business done there, and should people think about it in terms of positives and negatives? I'm happy for Jen or Carly to take that.
Yeah, so I don't have a lot of clients that actually have started doing business in Wyoming. But I mean, there is the possibility to consider that just because there isn't a corporate income tax.
Okay.
From my point of view, I deal with quite a well-known client who complains about tax rates in Malibu, where he lives. So I keep saying you ought to relocate to Wyoming then and save some state income taxes. I mean, Wyoming is the least populous state in the USA, apart from Alaska, I think. So there aren't many people there.
Okay. Mike, one for you. Going back to Mike's presentation, is there much of an advantage of registering in Delaware versus New York for a business that will be based in New York City?
Not necessarily. I mean, we do have quite a few clients who've set up under New York law. I mean, that might be one for Jen to actually answer as well. I think one of the problems is because you've got 51 different sorts of corporate law in the States. If you go and register a company under Arkansas law, and then you go to Washington State, you might not find a lawyer in Washington State that knows about Arkansas law, whereas I think Delaware law is really well understood throughout the USA. I mean, is that a fair comment, Jen?
Absolutely. Absolutely. And Delaware there's a lot of advantages to Delaware, from corporate law formation issues, privacy issues, and all sorts of other issues that make it a desirable state. What the advice that we generally give to our clients is, if you're not going to be operating in a particular state, then Delaware generally is a good place to be. But if you're going to have significant operations, for example, in New York, you're already going to be paying, based on the new market sourcing rules, you're generally going to be paying taxes, and you're going to be filing a return anyway. So the benefits of Delaware may not be, the benefits of Delaware may not be as evident if you didn't have a particular state that you were operating in. So really, Delaware allows you to avoid the income tax, to avoid, you do a filing, but you don't do a return. But if you're operating extensively in states and required to file anyway, sometimes the benefit is lost there.
Thank you. While we're going, this is probably a Jen or Carly thing rather than Mike thing. What changes to the current tax regime is likely to happen in the near future under the Biden administration?
I'll take that one. Because I know this is a big one that everybody's very, very interested in. And, please feel free to let us know if you know anything we may not know, because nobody seems to really know where anything is going here. I would say that the biggest thing, like Carly mentioned, is going to be the increase in the rate to 28% from 21%. Clearly, 28% is much better than we've historically had at 34 and 35%. But it has been a significant benefit that we never had before, as being one of the lower taxed countries. So clearly, that's something that we need to think about. Another thing is, if you're setting up a U.S. subsidiary, which generally, as Mike mentioned earlier, is really generally the way to go when you're setting up in the U.S. You want to avoid, the foreign jurisdictions, fighting over profits and all of that, and getting under the PE rules and that sort of stuff. And the treaty between the UK and the US is very specific in terms of, a subsidiary being treated as a PE. They're very clear in saying that in and of itself doesn't create a PE. So you have to think about all of those things. And so when you have a US subsidiary, thanks to the TCJA back in 2017, there's been a lot of, income tax consequences associated with this. One of them is GILTI, which some of you probably have heard of. And it's global intangible low taxed income rules. And essentially it just means that if you have a US entity that owns a foreign entity, a certain percentage of a foreign entity, they're going to have to pick up certain income. And that obviously can be an issue. Those rules are supposed to get even more stringent. So having that kind of a structure, perhaps if you have a sandwich structure, which is not recommended, but that we do have some clients, unfortunately, that come to us with a sandwich structure, which means that you have a foreign entity owning a US entity, owning a foreign entity. That's obviously not very tax efficient, at least not from a US perspective, but there you can have these guilty implications as well. And of course, I don't need to talk about what's going on, what just happened with the G7 and all of that, and the global minimum tax that is being proposed out there that would essentially be about, I think 15% is what they're talking about now. So obviously there's a lot that's going on out there, and it's really a crapshoot what we're going to end up with.
Okay, so this is quite a specific question, and maybe hopefully a shorter answer, Jen. Hopefully a less kind of broad question. We have started to trade in Florida, but are registered in Delaware. We've purchased software and support for our printer from a supplier based in New Jersey. The supplier has asked us for a tax exemption certificate. Do we need to apply for this from Florida or every state we purchase goods from? Carly or Jen?
So I'll take, that's really a state and local tax question, but I will, from my many years, I'm not dating myself, but from my many years just in tax in general, generally when you're talking about an exemption from sales tax, I imagine.
Yes.
And yes, so every state essentially has their different rules for exemptions. So one exemption, you generally can't get a blanket exemption certificate that covers all of the states. You would have to, and they have different rules for what could be exempt, services versus goods and what type. So that seems like
a good answer. There's a wider question here, which maybe you can start with, Mike, which is, what are the most common mistakes you see when a company looks to expand in the US, financial or otherwise? You're on mute, my friend.
Just unmuting. I think the most common mistake is that I've come across is that they've gone off and talked to a US attorney who doesn't know much about tax in the UK and the US, and come back with an LLC, and that gives us all sorts of problems. And they've suddenly got to tell their EIS investors that their EIS investments no longer qualify. That could be problematic. So ending up with the wrong entity is an easy thing to get wrong. And that would be the one I would pick on.
Okay. Did Jen or Carly want to add? We can move on. We have more questions, so I'm happy for you just to let that go and leave it with Mike. HMRC, which is obviously the UK equivalent of the IRS, takes a dim view of groups cross-charging service fees, etc. Does the IRS take the same sort of view? That, I think, obviously relates to management charges, etc.,
yeah.
Transfer pricing, exactly.
Of course. Yes, the IRS does. There's a lot of requirements, onerous requirements for transfer pricing documentation in the U.S. We have now, country by country reporting and all that sort of stuff. So transfer pricing is generally the number one issue that's on an IDR from the IRS.
Any advice for maintaining, this is probably Mike actually, for maintaining financial oversight of a US branch from the UK?
Right, any advice for maintaining, good question.
One thing I would say, actually, while I think about it, and you can think for 2 seconds, Mike, the one thing that I think always catches people out when you try to deal with things from the UK are things like 1099s, which are very specific forms to the US in terms of contractor payments. Those are obviously not something we're used to in the UK, and so can kind of fly under the radar and create huge problems if you miss them. Sorry, Mike, that's my 2 penneth.
I mean, financial oversight, many people in a startup situation will keep financial oversight by actually running the accounting from the UK. So you've got direct access to, you're actually running the accounting. So from that side, you can actually keep an eye on what's going on. People often do that rather than actually set up a totally independent accounting function over there.
Okay, actually, in terms of time, I might take this as the last question and I'll let you all have a go at this one. It's a multiple choice question in terms of answers. So ahead of registering an entity, who should we speak to first? A UK accountant, a US accountant, or an attorney? If you all give different answers, it'll be slightly problematic, but I'll let Mike go first because he's bound to say UK accountant.
I'm going to say UK accountant because it's the right answer, obviously. Well, I think at the end of the day, you can only put the advice together with input from all three parties. So there you are. I'm throwing. You've got to start somewhere, and I think understanding what's happening in the UK first and what your business is in the UK is probably the best place to go, but it doesn't have to be. But I'd obviously quite like it to be for obvious reasons.
Jen or Carly, do you want to disagree?
No, not disagreeing with Mike.
Awesome. So we are pretty much up with the hour, and obviously I'm keen not to overrun and take up more of your days than possible. So thank you all very much for attending. Thank you to Mike, Jen, Carly, and Gus for your very valuable contributions. If anybody has more questions, then please just feed them through to us, and as necessary, we'll get you answers from Jen or Carly or Gus. So thank you all very much, and good to see you, and have a good rest of your days. Thank you.
Thanks,
Thank you,
everybody.
everybody.
Take care now. Bye-bye.
Thank you.
Take care.